Financial capital and ethics, the two always go hand in hand. So, congratulations. You've just graduated to the blue section. We're on the fourth bar now. Okay, so we're now between years 5 and 6, and we're almost ready to take our company public. Okay, we're probably going to do one last round with a late stage venture capital firm rather than the earlier stage ones. And the best late stage venture capital firm in the world is a firm called Meritech, based in Palo Alto, California. And so we're going to deal with them to do one last round. We're also going to think about taking on a little bit of debt. Okay, but remember before I said debt is bad and you shouldn't use debt. It's okay later on when you're profitable or cash flow positive, or you can use a convert instead of debt. And we're going to partner with the best venture capital debt firm in the world, which is called Silicon Valley Bank, or SVB. Okay, great. So let's get started. Before I jump into this section, I want to revisit passion. I just want to make sure that you're incredibly passionate about your work. Set extraordinarily high standards for yourself. And again, just find your passion and you'll never have a job in your life. And to be honest, it took me a while to find my passion. I started out in the technology consulting industry. Then I worked in the hedge fund industry. I worked for Goldman Sachs. And I finally found my true passion, which is venture capital. And I love it because you're a long-term investor. You're kind of a prosthetic extension of the management team of the companies you invest in. You can help them grow. I love it. It's a lot of fun. That's my passion. And I feel like I don't have a job, which is fun. And I actually love teaching as well. So those are my two passions. Anyway, find your passion. Find your raison d'être, or the reason you were put on this earth professionally. Find out what it is. And again, you'll never work a day in your life. Okay. New topic. We're going to talk about ethics. And so I worked at Goldman Sachs from 1998. I worked part-time through business school at Columbia. And then I left Goldman in 2003. And my first day at Goldman Sachs, they took all the associates in my class, all 100 of us from various schools, whatever, and they fingerprinted us. And they said, welcome to Goldman Sachs. You have a better chance of doing harm than good to this company. Don't do anything that's going to get you on the cover, or the firm on the cover of the Wall Street Journal. And they said it in very nice terms. And I've got a lot of respect for the firm. They, I don't really know that many unethical people that have come out of that firm. But they took ethics very seriously. And I'm certainly glad they did. Now, I want to talk about one SEC issue, which was the Galleon case. Galleon was a big hedge fund in New York City. And greed settled in, and insider information kicked in as well. And as a result, a number of people went to jail. And quite often, people break the law, and they might not know they are breaking the law. And so before you enter the financial services industry, it's an obvious statement to you that you should take the Series 7 exam or the right certifications. Just make sure you know the rules, and always err on the side of being cautious. If you're not sure about something, talk to the compliance director if you work at a big firm, or do research on the internet to make sure that you're not breaking the law. Because in this day and age, 1 millisecond, one wrong mistake, or wrong trade, or wrong idea can just ruin you. And as Warren Buffett said, it takes 20 years to build a reputation. And he said 5 minutes. I believe it's 5 seconds to destroy it. So I will keep coming back to ethics. And then with Galleon, many people were involved in this insider information ring. And you can just go to YouTube and do a search on it. CNN and CNBC have done a very good job of covering it. So just be very, very careful in general. Okay, so email and phone calls are forever. So assume that every email that you type for the rest of your life, and every phone call you make, and every Snapchat picture you take, yes, that's right, assume all that stuff is forever and can't be undone. Okay, so just be careful. So let's now talk about the differences between finance and accounting. Accounting is more focused on accrued revenue and expenses. meaning revenues you can recognize. And accounting is a bit more of a science, and finance is a bit more of an art, okay? Finance is more focused on cash revenue, like real money in your pocket, and expenses, okay? So finance is more focused on the cost of capital, the cost of getting that, getting money, okay? And finance is also more focused on the cost of equity, and it's qualitative as well. And so let's look at a couple different charts here to kind of analyze the difference between earlier stage and later stage companies. And so on the x-axis, we have time. And you've seen these pictures before. This is a company in the early stage, meaning a seed stage firm, all the way up to IPO or mature firm, big tree. Okay, so the interest rate, the cost to raise money or the cost to get a loan for a startup, and this is common sense, the cost of interest for a startup, for a bank, or for a loan is very high. And obviously the cost of capital or a loan for a well-known company with great cash flow like IBM is very low, okay? Now, financial modeling timeframe. Startup companies or seed stage or earlier stage companies, you need to model monthly. And then larger mature companies model quarterly or yearly. Risk. There's obviously a lot more risk with an earlier stage company than there is a later stage company. Corporate governance. This one's important. There's better corporate governance usually, meaning they break fewer laws, when companies are mature. Why? Because there are more board of director members or more board members, as you can see on this image, okay? And so the bigger your firm gets, or after each venture capital round you do, A, B, C, D, or whatever it is, you get one new board member, okay? Then you go public and you have more board members. So corporate governance or ethics is usually less of an issue for later stage companies. There's just more checks and balances involved. Patents. Okay, we talked about patents in the first day today of this course. So patents are pending, usually for very early stage companies. They haven't been granted yet. And later stage companies have many more patents to protect their moat or their IP or their intellectual property. And that actually goes hand in hand with risk. Risk is lower usually for later stage companies. Okay, let's talk a little bit about debt. We've talked a lot about equity in this course so far. So the nominal interest rate is the interest rate of a bank loan. Okay, it's just legal terms or finance terms. Okay, so you might ask yourself, well, if I'm going to get a loan, how does somebody measure my liquidity risk? Meaning how fast can I turn all of my assets to cash? Or inflation risk, or default risk, or time risk? How do they account for all that stuff? Well, the cost of debt is equal to all that stuff added together, plus the real interest rate, meaning the rate that the banks can, the government loans the banks. Okay, so what is the lowest risk interest rate? Okay, it's always U.S. Treasuries. Okay, always the lowest risk investment you can make in the world, for now at least, is U.S. government Treasury bills. Okay, or interest rates from the government. Okay, there's literally no default risk there. Thank you, China. Okay, so the risk-free rate, okay, meaning the rate you get when there's no risk at all, is just the real rate of interest plus the inflation premium. Okay. Now, don't worry if you don't fully understand all this stuff, because I'm going to come to a crescendo at the end of this lecture, and you'll say, "Ah, I get it." Okay. So, what the heck is a yield curve? And why does that stuff matter anyway? You've heard that term yield curve. What is a yield curve? Well, you can actually go to the U.S. Department of Treasury's website, and you can draw the yield curve yourself. It's pretty easy, and I'll show you how to do it. So basically what you do is you take time on the x-axis, and then you've got interest on the y-axis, and you can create your own yield curve. Okay, so what, Chris? What does this mean? Well, the yield curve will tell you, what interest rates are going to be longer term, right? And so interest rates can't get any lower than they are right now, right? So obviously interest rates will be higher longer term because they can't go any lower. And so you can plot on that curve what the interest rate is going to be longer term, or at least what the market expects the interest rate to be longer term, okay? And this is an interest rate for government securities, okay? Now, how do you calculate inflation? Well, you can go to the Bureau of Labor and Statistics website, bls.gov. Just take a look at the slide in front of you. And you can calculate how much stuff that you bought in 1991, for example, is worth today. And it always changes on this website. So for example, 10 bucks in 1991 is worth 17 bucks today, roughly, okay? And that's how you calculate inflation, okay? It's pretty easy. And I actually did this process last year, and it told me that $10 in 2014 was worth $9.99 in 2015. Wow, that's a big deal. It's a huge deal because it shows that we were in a slightly deflationary environment. And until recently, we haven't seen rates rise, since 2006. Why? Because the government was basically telling us that they didn't have confidence in the economy, right? That's a signal. Right? So the world almost ended in 2008, and we'll cover why later, right? And the government kept interest rates ridiculously low for many, many years until the economy was a little bit better. So what is all this interest rate stuff? What does it mean? So the government, usually when the economy is doing very well, the government likes to raise interest rates, okay? And the way they do that is they actually, they sell bonds, right? You're like, what does that mean? Well, they sell bonds, and a lot of banks will buy their bonds, right? And the banks will give the government a lot of money in return for bonds. And the government gives the banks pieces of paper called bonds that will say, we will pay you a certain interest rate, right, for this money. And the government takes this money and puts this money out of circulation. And so all of a sudden there's less money out there, right? And so if the demand for money stays constant and the supply goes down because the government has all that money, right, from the banks because they bought bonds, then that means that the price of money is going to go up. Interest rates are going to go up, okay? And then what the government does to lower interest rates is they do the opposite of what I just said, okay? So that's how interest rates are manipulated. And it's a very powerful weapon for governments to have, the ability to manipulate interest rates. It's actually the most important weapon that all governments have. And that's why there's a lot of controversy around Bitcoin. Because if the government can't control what the price is of a Bitcoin, then the government has less power, right? It can't print bonds to, build roads or declare war or whatever it is. Okay, enough of that segue. Now, inflation was actually slightly negative at one point last year, according to this BLS website, right? And so if you get a chance, I encourage all of you to please go online and watch the movie Too Big to Fail. Okay, it was shown on HBO a couple of years ago and explained the 2008 crisis in great detail. It was an amazing movie, right? And basically what happened was nobody could get loans then, and we were within. This sounds crazy, but it's true. We were within 24 hours of bank machines actually not working. It was a very scary time. Everybody was over leveraged. Right, and so remember Warren Buffett has mentioned before that leverage is basically financial weapons of mass destruction. So be very careful with leverage. And I'm not going to go into too much detail on more stuff that happened then, but watch that movie if you can, or rent it online. It's a good flick. Okay, so the risk-free rate is equal to what we found to be the interest rate from the yield curve of 0.24%. Plus inflation, and inflation was slightly negative when I made that slide. It's actually a bit positive now. So we know that inflation is going to be much higher in the future, and we all know that nobody will lend to us at the rate I just showed you on the previous slide, right? So we live in very interesting times. So no wonder you're seeing a lot of egregious or high valuations for less liquid investments, right? So real estate prices are very high. Their venture capital prices are very high, right, for investments. There's lots of unicorns out there. Why? Because interest rates are very low, right? And the government is basically encouraging people to take risk. Get a loan from the bank, invest, use leverage. It's dangerous. But I will say this, when interest rates go up, you won't see people investing as much in real estate, right? Because mortgage rates will go up. Or venture capital, right? Because these are illiquid investments, okay? In fact, so when rates go up, people prefer to put their money into banks, right? It makes sense. The rate's higher. You can earn, 5, 10, 15%, whatever the interest rate is. Why buy stocks, right? So, and I remember in the early 80s, I lived in Canada, and I remember that interest rates in Canada were close to 20%. And I remember my dad, it was very stressful to actually get a mortgage to pay for the house. So anyway, the biggest weapon the government has is the ability to increase or decrease interest rates. Okay. All right, let's move on. So you can't get a loan at 0.24%. And the reason is, and even though that's a stated interest rate, the banks need to assess what risk they have lending to you in terms of liquidity risk, inflation risk, default risk, and maturity risk. Okay, so again, the cost of debt is equal to all that stuff added together plus the real interest rate. Don't worry if this is confusing. Just give me a moment here. Okay, so a mature cash-rich company would pay a much lower interest rate or a lower cost of debt. So here's the yield to maturity for IBM. I went to a website called Morningstar.com, and I see the bonds price for IBM. See, it looks like a yield curve, just like the government yield curve. Okay, and you can see the interest rates are higher than the government rates, but not that high, because IBM is a very cash flow rich, mature company, and IBM is never going to go out of business. If it ever were to, of course, the government would rescue them, kind of like GM, which stands for Government Motors. Okay, so let's just keep all this stuff simple, though. Okay, I gave you a little bit of background in terms of how the world works. Okay, we all just refer to banks lending at the prime rate for their best customers, or prime plus X for higher risk customers. Okay, but in the real world, all this risk math and formulas I gave you is a waste of time, okay? I want you to understand the underlying economic drivers, though. In the real world, the way it works is this. We all rely on ratings agencies like S&P and Moody's, okay? It's just the way it works. I'm not saying it's good or bad, okay? So, and these companies give different ratings for debt, right? And the better the rating, the lower interest you'll pay on this debt. And so AAA, you probably heard this before, it's the best rating you can possibly get, right? Interest rates are low on companies that issue bonds, right? Or get loans from people or banks or whatever it is, right? If it's a AAA rated bond, then the interest rate's low. Then you go to AA, which is worse, right? Then A, then you got triple B, double B, B, CCC, et cetera. You get it, right? And anything that's triple B or higher is called investment grade, which means it's a good investment, right? Or a low interest rate, or your money is relatively safe, relatively. Anything lower than that is called a junk bond or high yield. And there's this guy named Michael Milken that basically created this industry in the late 1980s, and he was absolutely brilliant. Although he got into a little bit of trouble, but he's cool now. He's doing a lot of charity work. Okay, and so investment grade means that the default risk premium is less than 1% above treasuries, okay? So the percent chance of defaulting is quite low. And then the default risk premium on junk bonds or high yield bonds is 5% above treasury rates. That's higher risk, okay? So early stage companies that are dumb enough to get bonds or loans, they pay very high interest rates or junk bond rates, which is why they prefer to deal with equity investors or VC financing. And so when interest rates are low, many companies are born, okay? And if inflation is high, like in the early 80s, remember I gave you the example about my father and the mortgage, then the economy is slower and startups, generally speaking, aren't born, or not many are.